Welcome back to Report of Silver, your trusted source for in-depth gold and silver market analysis. On this channel, we cut through the noise and focus on what really matters in the precious metals market, giving you clear insight into where gold and silver may be heading next, and what those moves could mean for investors, stackers, and anyone trying to protect their wealth in a rapidly changing financial world. Today's discussion is one of the most important we have had in a long time, because the message coming from respected momentum analyst Michael Oliver is not just about another short-term move higher in metals. His argument is much bigger than that. He believes we may be entering a phase where gold and silver are not simply rising assets, but assets that are being redefined by the market as money again. That is a powerful claim, and it deserves serious attention.
According to Michael Oliver, what we are witnessing now is not the end of a rally or the beginning of another long correction. Instead, he believes we are sitting in the middle of a major congestion zone, a temporary pause before what could become an explosive next leg higher. His outlook is especially aggressive on silver. In his view, once silver clears this long-standing resistance zone, the move could become extremely fast and extremely violent. He has repeatedly stated that silver could move toward $300 in a matter of months once the current range finally breaks. That sounds dramatic, but when you understand the technical framework behind his argument, it becomes much easier to see why some analysts believe that possibility cannot simply be dismissed. One of the biggest mistakes many investors make is assuming that because gold and silver have paused, the bull market must be ending. That is exactly the kind of thinking Michael Oliver challenges. He points out that what looks like a dramatic move on a normal arithmetic price chart often looks very different on a logarithmic chart. This matters because arithmetic charts exaggerate emotional reactions. They make every move look bigger than it really is. A log chart, however, shows percentage relationships and helps analysts understand whether a market is truly becoming parabolic or simply continuing within a normal long-term trend structure. When Michael Oliver studies gold using long-term momentum analysis, he does not see a market near exhaustion. In fact, he sees the opposite. He reminds us that gold rose roughly eightfold between 2002 and 2011. That was a true historic bull move. Today, by comparison, gold has only risen roughly 4 to 4.5 times from its 2015 bear market low. That means, from a percentage perspective, this bull market has not yet matched previous major secular advances. Yet many investors are already calling this a blow-off top simply because the nominal price looks high. That is exactly the trap that emotional chart reading creates. Silver tells an even more compelling story. We have seen silver rally toward the $90 level multiple times, only to be pushed back each time. For many investors, repeated failures at resistance create frustration and fear. But in technical analysis, repeated testing of resistance often weakens that resistance. Every time silver pushes toward that level, more supply is absorbed. More sellers are exhausted. The market builds pressure. Michael Oliver's view is that if silver reaches that level again and finally breaks through, the move afterward may not be gradual. It could become vertical. That idea fits perfectly with what we have been discussing here on Report of Silver for months. The silver market has been trapped in a tug-of-war between physical demand, tightening supply, industrial consumption, and paper market suppression. That tension creates exactly the kind of energy that can lead to explosive breakouts. Markets often spend much longer building pressure than investors expect, but when they finally release that pressure, the move can be breathtaking. What makes this moment especially important is that Michael Oliver is not basing his view on headlines or emotional narratives. He is using momentum structures, long-cycle technical signals, and relative performance charts. In his framework, the recent drop in gold and silver did not damage the long-term bullish structure at all. It only interrupted the intermediate trend. That is a critical difference. Short-term weakness does not automatically mean long-term failure. In fact, many of the strongest bull markets in history experienced violent corrections before accelerating higher. So the big question now becomes simple. Are we watching the end of a move, or are we watching the launch pad for the next major phase? According to Michael Oliver, and increasingly according to the market structure itself, the answer may be that this is only the beginning of the acceleration phase. And if that is true, investors who mistake this sideways range for weakness could be making one of the biggest mistakes of this cycle. One of the biggest fears in the precious metals market right now is the comparison to 2011. Many investors remember what happened after gold and silver made those historic highs. Gold peaked, silver collapsed, and what followed was a brutal multi-year bear market that destroyed confidence across the sector. That memory still shapes investor psychology today. Every time gold pauses or silver gets rejected at resistance, people immediately ask the same question: is this another 2011? According to Michael Oliver, the answer is clearly no, and his reasoning is rooted not in emotion, but in long-term momentum analysis. Michael Oliver argues that in 2011 the warning signs were visible long before the final crash, but most investors ignored them because they were focused only on price. That is a lesson worth repeating. Price alone does not always tell the full story. Sometimes the deeper truth is hidden beneath the surface, and that is where momentum becomes so valuable. In his work, he studies annual momentum structures, not daily headlines or weekly volatility. Back in 2011, those annual momentum charts showed a very clear breakdown. A major multi-year support line was broken. That break told him the long-term bull trend had been damaged. The price itself did not collapse immediately, but the momentum structure had already given the warning. That warning proved correct. Gold spent more than a year struggling after the top. It never regained its highs, and eventually the market collapsed into the 2013 crash before falling all the way toward $1,050 by late 2015. Investors who were only watching price believed the market was simply consolidating. Those who watched momentum understood something deeper had changed. That is why Michael Oliver puts so much emphasis on momentum today. Now compare that environment to what we are seeing now. Gold recently experienced a sharp correction. Silver also pulled back aggressively. Many investors panicked. Headlines started talking about blow-off tops and market exhaustion. But when Michael Oliver looked at the long-term annual momentum structure, he saw no damage at all, not even close. According to him, nothing in the recent pullback threatened the core long-term bullish trend. The only thing affected was the intermediate trend, which is a much shorter cycle. Those trends can weaken for a few weeks or even a few months, but they do not determine the fate of a decade-long bull market. This distinction is extremely important. A lot of investors confuse volatility with failure. They see a sharp decline and assume the story has changed. But markets do not move in straight lines. Especially in precious metals, violent pullbacks are often part of the normal process. In fact, some of the strongest bull markets in history included sudden corrections designed to shake out weak hands before the next major move higher. That appears to be what Michael Oliver believes happened in this case. He points specifically to the late March sell-off as evidence. During that move, both gold and silver briefly broke below previous lows. For many retail investors, that was terrifying. Stop losses were triggered, emotional selling accelerated. It looked like the beginning of a much larger collapse. But then something important happened. The market reversed sharply. Silver, for example, spent only a short time below support before snapping back aggressively. That kind of move often signals what professionals call a false breakdown. Instead of confirming weakness, it confirms strength because it shows buyers were waiting beneath the market. This is how institutions often operate. They allow panic to build, they let retail investors exit in fear, and then they absorb the supply. Once weak hands are gone, the path higher becomes much easier. That may be exactly what happened here. Michael Oliver sees that March low not as a warning sign, but as a cleansing event, a final flush before the next major advance. That interpretation changes everything. If the March low was indeed a cleansing low, then the current sideways range is not a danger zone. It is a launch pad. It is a place where energy is being stored. And history shows that when metals break out of these kinds of congestion zones, the move afterward can be much faster than anyone expects. That is why comparing today to 2011 may actually be misleading investors. In 2011, long-term momentum was broken. Today, it is not. In 2011, the market was exhausted after an eightfold rise. Today, according to Oliver, the current move has not even matched previous secular bull markets in percentage terms. Those are two very different environments. If there is one part of Michael Oliver's outlook that gets the most attention, it is his bold forecast for silver. While many analysts are comfortable talking about silver reaching $100 someday, Michael Oliver goes much further. He has repeatedly stated that silver could move toward $300, and not over many years, but very rapidly, potentially within 3 to 4 months after breaking out of the current congestion zone. That is a massive statement, and naturally it sounds extreme to many people. But when you study how silver behaves during major bull cycles, his argument starts to make more sense. Silver has always been a different animal than gold. Gold usually moves first because it is the primary monetary metal. It attracts central banks, institutional capital, and conservative investors looking for safety. Silver, however, tends to move later in the cycle, but when it moves, it often outperforms dramatically. That is because silver is a much smaller market. It takes less capital to move the price, and once momentum builds, price discovery can become explosive. We have seen this before in history. In the late 1970s, silver dramatically outperformed gold. In 2010 and early 2011, silver surged in a near-vertical move. Michael Oliver believes we may be approaching another one of those moments. What makes this setup especially interesting is the repeated battle around the $90 level. According to Michael Oliver, silver has rallied toward that area multiple times since the initial major drop and has been sold each time. Most investors see repeated rejection as a sign of weakness. But in technical analysis, repeated testing of resistance often means pressure is building underneath. Every time price approaches resistance, more sellers are exhausted, more supply gets absorbed, the wall becomes weaker. Eventually, when that wall finally breaks, there is very little left to stop price from moving rapidly higher. That is why Michael Oliver says if silver reaches that level again and pushes through, they're going to blow your head off. What he means is that the breakout may surprise nearly everyone in speed and scale. Investors waiting for a calm confirmation could miss the move entirely. That is often how silver behaves. It spends long periods frustrating people, then suddenly explodes higher when nobody is positioned properly. There is also a fundamental reason why silver may outperform gold in the next phase. Unlike gold, silver has a dual role. It is both a monetary metal and a critical industrial metal. That creates a unique supply and demand equation. Industrial demand continues rising through solar panels, electronics, artificial intelligence hardware, military systems, and next-generation energy technologies. At the same time, physical investment demand remains strong because many investors see silver as undervalued compared to gold. That creates pressure from both sides. On this channel, Report of Silver, we have discussed this repeatedly. Silver is not just sitting in vaults. It is being consumed. It is being used. A large portion of industrial silver demand is non-recoverable in the short term, meaning once it is used, it effectively leaves the available supply chain. That matters because silver's above-ground inventory is far smaller than many people assume. Now combine that physical reality with technical compression. That is where the story becomes powerful. Michael Oliver is not simply saying silver will rise because he feels bullish. He is arguing that the market structure has been building pressure for years. Long-term congestion zones are not meaningless. They represent stored energy. The longer a market stays trapped, the more violent the eventual breakout can become. This also explains why silver often frustrates retail investors. Many people buy silver expecting immediate upside. When it moves sideways for months, they lose patience. Some sell, others stop paying attention. But that emotional fatigue is often part of the process. Markets wear people out before they reward them. That is how weak hands get removed from the market. Michael Oliver believes that is exactly what is happening now. He sees this period not as weakness, but as preparation. He sees silver not as broken, but compressed. And once that compression ends, he expects silver to outperform gold in dramatic fashion. That is an important distinction. Gold may continue to rise strongly, but according to Oliver, silver could vastly outperform. For investors looking for torque, for leverage, and for potentially life-changing upside, silver remains the more aggressive opportunity. In Part 4, we will look at why Michael Oliver believes this is not just a metals rally, but part of a much larger global shift in confidence, where gold may once again be recognized as real money. What makes Michael Oliver's outlook different from many other analysts is that at a certain point, his thesis stops being only about price charts and starts becoming about something much larger. He believes this next move in gold and silver may not simply be another cyclical bull market. Instead, it could reflect a deeper shift in how the world views money itself. That is a much bigger idea, and if he is correct, then the long-term implications for gold and silver could be enormous. His argument is straightforward. He believes that once this next major move unfolds, the world may not simply look at gold as an investment anymore. It may begin to recognize gold as money again. That sounds dramatic, but history shows that gold has always returned to prominence during periods when confidence in fiat systems begins to weaken. For decades, governments have relied on paper currency systems built entirely on trust. That trust has held because most people believe those systems would always work. But what happens when that confidence starts to crack? That is the heart of Michael Oliver's thesis. He believes enough economic and political pressure is building globally that confidence in fiat systems could face a major challenge. Rising debt, repeated banking stress, persistent inflation, and weakening public trust in institutions all create pressure on the current financial structure. At some point, markets begin searching for alternatives. Gold has historically been that alternative. We are already seeing hints of this. Central banks around the world continue buying gold at elevated levels. Countries that once depended heavily on the US dollar are exploring alternatives for trade settlement. More governments are openly discussing reserve diversification. These are not random headlines. They are signals of shifting priorities. Gold is quietly being repositioned at the institutional level, even while many retail investors remain focused only on daily price movements. Michael Oliver takes that one step further. He believes that after the next major move, we may reach a point where gold is acknowledged not just by investors, but by governments as a stabilizing monetary asset again. He points out that history has seen dramatic policy reversals before. Governments have restricted gold, changed monetary systems, and redefined reserve structures multiple times. What seems permanent today may not be permanent tomorrow. That matters because markets often move before public understanding catches up. By the time average investors realize that gold is being treated differently, much of the move may already be over. Michael Oliver warns that precious metals often price the future before headlines explain it. That means investors waiting for official confirmation may arrive far too late. This is also why he believes gold may not return to old levels once it reaches a new pricing zone. Yes, there will always be corrections. Every bull market has them. But he does not believe gold returns to something like $2,000 once the next phase fully unfolds. In his view, the world itself may change enough that a new valuation framework takes over. In that framework, gold is not merely expensive. It is re-rated. Silver benefits from that environment as well, perhaps even more dramatically. If gold regains broader monetary recognition, silver historically follows because it shares that monetary identity, while also carrying industrial demand. That combination can create a powerful multiplier effect. Investors looking only at current spot prices may underestimate how quickly sentiment can change once markets shift into a new reality. Michael Oliver also ties this outlook to political instability. He notes that confidence in institutions often looks strongest right before it begins to weaken. Political division, policy uncertainty, and public frustration can all contribute to declining trust. When that happens, investors naturally look for assets outside direct political control. Gold and silver fit that role perfectly. This is why he says the biggest move often happens before the public fully understands what is happening. Markets do not wait for consensus. They move based on positioning. They move based on expectation. They move based on capital searching for safety and credibility. Precious metals may already be telling us that story. That is why this conversation is bigger than simply asking whether silver can hit $100 or whether gold can hit another record high. The deeper question is whether the global monetary system itself is entering a period of reassessment. If that is happening, then gold and silver may not simply be rising assets. They may be early indicators of a much larger structural shift. One of the most overlooked parts of this entire precious metals story is the mining sector. While most investors focus only on gold and silver prices, Michael Oliver believes mining stocks may be setting up for one of the biggest relative breakouts in years. In fact, his view is that miners could eventually outperform even the metals themselves once the next phase begins. That may sound surprising because mining stocks have disappointed many investors over the last decade. Even as gold and silver moved higher, miners often lagged. That underperformance frustrated the market and caused many investors to give up on the sector entirely. But according to Michael Oliver, that long period of disappointment may actually be the reason the opportunity is now so compelling. To understand his argument, we need to look at miners relative to gold, not just in absolute price terms. Michael Oliver studies the ratio of mining indices like the XAU and GDX compared to gold itself. Historically, for decades, miners traded at much higher valuations relative to the price of the metal they produce. On average, the Philadelphia Gold and Silver Index, known as XAU, traded at roughly 25% of the price of 1 ounce of gold. That relationship held for decades through the 1980s, 1990s, and much of the early 2000s. Then something changed. During and after the 2008 financial crisis, miners began dramatically underperforming. By the time the sector bottomed in late 2015, that historical relationship had collapsed. Instead of trading near that long-term average, miners had fallen to only around 4% relative to gold. That was an extraordinary undervaluation. As Michael Oliver says, when something that historically traded around 25% falls to 4%, the question becomes simple. How much cheaper can it realistically get? Since that 2015 low, miners have remained trapped in a relatively narrow range compared to gold. They have bounced between roughly 5% and 8% on that relative chart, but they have not broken out decisively. That is where Michael Oliver sees opportunity. According to his momentum work, that long 11-year base may finally be nearing completion. In technical analysis, long bases often precede powerful breakouts because they represent years of accumulation and compression. This is important because large institutional investors often prefer miners over physical bullion. Many large funds do not want to store gold bars or buy silver coins. They want liquid equity exposure. That means when institutional capital decides it wants precious metals exposure, miners often become the easiest vehicle. If that rotation begins, money can move into the sector very quickly. That is why Michael Oliver believes miners could gush higher once this breakout is confirmed. His language is strong because he believes the move could be dramatic. He has suggested miners could potentially double or even triple relative to gold in a relatively short period. That would mean investors who have ignored the mining sector could suddenly find themselves chasing a market they had dismissed for years. This also fits a broader historical pattern. In many major precious metals bull markets, gold moves first, silver then accelerates. Finally, miners often deliver some of the strongest percentage gains because they offer operational leverage. If gold rises 20%, a profitable miner can sometimes rise much more because its margins expand faster than the underlying commodity price. Of course, mining stocks carry additional risks. They are still equities. They face management risk, political risk, production risk, and general stock market volatility. Michael Oliver acknowledges that. But his point is not that every mining stock will succeed. His point is that as a group, the sector remains deeply undervalued relative to the metals themselves. That is why this entire discussion matters. Michael Oliver is not describing a normal market cycle. He believes gold remains in a strong long-term bull trend. He believes silver may be on the edge of a vertical move. And he believes miners may be preparing for a historic relative breakout. Whether or not his exact price targets prove correct, the broader message is clear. The precious metals market may be much closer to an acceleration phase than many investors realize. That is the key takeaway for all of us here on Report of Silver. Do not let short-term volatility distract you from long-term structure. Markets often test patience before they reward conviction. And if Michael Oliver's analysis is right, this may be one of those moments where patience is about to matter a great deal. If you enjoyed this analysis, make sure you subscribe to Report of Silver, because in markets like these, understanding the bigger picture can make all the difference.